Good afternoon, or possibly good morning, depending on where you're listening to us from today. But I want to welcome you to our webinar on investing in real estate with a solo 401k. Those of you who are familiar with the webinar series that we do here at Advanta, a lot of times we talk about investing in real estate but using an IRA and what that process looks like. But we're going to switch things up just a little bit today and focus a lot more on the solo 401k account and how that process works, how it's a little bit different, and probably even talk a little bit about what a solo 401k is as opposed to self-directed IRA account. So the focus of today's presentation really on the differences between the solo K and an IRA, and especially then when it comes to investing in real estate and what that process looks like. Now, if you're listening to us live at the webinar here today, if you have questions as we go along, please type them into the chat box on your screen. I'll make sure I get to those questions and get them answered for you, so you can utilize that feature. If you're listening to the recorded version, my information will be here on this next slide, and also at the end you can certainly call our offices, ask any questions that you have when viewing this webinar and the recording. Anyone who's listening to this live as well, you will get an email with the copy of the slides, also the recording link as well once we have that available. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years, doing a couple different things here in the office, but really focusing more of my time recently on helping people to understand what it is to self-direct, what the process is, what the rules are, and managing a few people that do that as well, and really educating people about what is possible with self-directed IRA accounts. Now, I also have had a lot of experience within the company dealing with the transactional side as well, and facilitating the investments of an IRA, or as we'll talk about today, a 401k, into purchasing the real estate itself and what that process looks like. I stepped away from that a few years ago, really focused more on the business development side, though, of the company now, both in our offices in Atlanta and in the Tampa Bay area, but of course serving clients nationwide. Now, quick disclaimer on Advanta and what we do and don't do. We don't provide legal, tax, or investment advice or endorse any particular products for our clients. I mean, we will talk about issues today that relate to the legal aspect of things you can or can't do within an IRA account or a 401k. I'll also talk about the tax implications of contributions and making the impacts it might have to open up a solo 401k. The tax implications it might have on you as an individual. But as far as giving advice, and certainly as far as endorsing any particular investment, saying this is the way you should go or you should invest here, that's something that we don't do at Advanta IRA. But we can certainly refer you to an attorney, to an accountant, someone else who'd be able to help you get those answers to the questions, and at least help you make that decision as well. Now here's our agenda for today. We're going to talk about, again, really self-directed 401k plans, and then the context then of from there of how to actually invest those into an IRA account. So we're going to talk about really kind of what self-direction is a little bit up front, go over exactly what a solo 401k is, and then put that learning and knowledge into the case studies and show you how that process works within a 401k. And again, if you're listening live, if you have any questions, please type those into the chat box on the screen, and we'll be more than happy to get to those questions during the presentation. Now, self-directed, and again, a lot of you on this call may already be very familiar with this, but the term self-direction simply means that the owner of in this case, the 401k, has the ultimate control over what types of investments the 401k makes. Now, a lot of individuals who have 401ks, if you're working through an employer, you probably are being given a list of different mutual funds or different assets that you could put your 401k funds into, but you really don't have much more control beyond that. You don't have the ability to invest in real estate or notes, mortgages, private placements, precious metals, so many other different things that you can self-direct, what we do with a self-directed 401k plan or a solo 401k. So again, self-directed is not a type of IRA. It's not a type of 401k. It really refers more to the ability of you, if you have that type of an account, to truly diversify your investment options. Now, one thing I'll preface the presentation with today is we're only talking about solo 401ks. These are accounts for individuals, typically who own their own businesses or who are sole proprietors. If you have a current 401k plan, so you're working for ABC Company and you're enrolled in their 401k plan there, you may or may not be able to self-direct those funds. That is something you'd have to talk to the administrator of that 401k plan about and see if you have the ability to typically roll over that money into a self-directed IRA. But we're really talking about 401ks today that are especially suited for, again, sole proprietors or people who own their own businesses, not only to have that account, but then in turn, of course, self-directs. Again, self-directed really refers just to the investment possibilities that you have and the fact that you're in control of those investments yourself. But why do people choose to self-direct? I think there's a couple different reasons why, and they're certainly not mutually exclusive. One is the IRA, or in this case the solo 401k, offers you a different source of capital to invest in assets you are already familiar with. So if I have a friend of mine who has a startup company, I'm familiar with the company because I've already invested some money personally with him. He's looking for additional money, additional investors, and I say, hey, I'm already familiar with that investment. I'd like to make an additional investment. I'm just going to use my IRA or 401k cash to make that investment. So for me, my motivation in self-directing is simply I see an opportunity, things I've already done personally. I can do this with my IRA, with my 401k account instead. Again, that's very true a lot of times as we'll talk about real estate, of real estate investors who already own a portfolio of rental properties, simply looking to buy their next property, their next opportunity inside their retirement vehicle. Now, for some clients, some individuals, they invest in a self-directed IRA because the investment gains from whatever it is that they're using their 401ks to invest in, those gains, those profits, those dividends come back into the 401k account on a tax-deferred basis. So it doesn't affect your personal tax return this year. If you have a rather large gain for an investment, if it's going back into your IRA or to your 401k plan, you don't have any tax implications. So if someone's looking at making an investment, the impetus for them using their IRA or 401k may be that they expect this investment to have a very nice return during the year, and I'm in a high tax bracket. I don't want that income personally. Let's do this investment inside a retirement vehicle and continue to defer the taxes. Now, a third reason, and again, these are not all mutually exclusive, is that a lot of people are frustrated. They're worried. They might be scared, depending on what their personality is, but they have their money in the stock market or they have money in mutual funds, things that are really out of their control. So you might have a great year in the stock market one year through nothing that you did because, again, you don't understand it. You just had your money placed there. But you're worried that at some point there's going to be a market correction or maybe these stocks that you hold aren't going to pan out well, and it just doesn't let you sleep easy at night. Okay, because you know that this is money that's invested, and as long as things are going well, you're doing fine. But if things start going bad, you really don't have anything to do other than just to ride that wave up and down. So a lot of individuals choosing the self-director because they want to be in control and be able to drive the types of returns, and really, in that case, control the assets in their IRA account. Lets them sleep easier at night, knowing exactly where their funds are located. And again, these are not mutually exclusive reasons. There are clients who invest in self-directed IRAs for all three of those reasons. May all gel together and be the impetus for choosing self-direction. So a little bit about Advanta IRA as we get into the presentation, just so you know a little bit about what we do. We've been in the industry for quite a while. We work with clients all over the country. So although I mentioned an office in Tampa and an office in Atlanta, we do work with individuals all over the United States. We are not bound geographically at all by that, especially with the advent of email and DocuSign and other kinds of great technological advances. We can do paperwork that way. But certainly the cash that we hold is held in FDIC-insured accounts, so your cash is protected. We currently have over $900 million of assets. We should hit the billion-dollar mark very soon of total assets under management. And we do have a special system for handling all of our accounts. We think it's a little bit different than you're going to find with most self-directed companies, in that we appoint an individual account manager to each account that we open, which really gives you a much more of a concierge-type service. You have one point of contact, one individual who's going to help you then regarding your account and anything that you need for your account. That one point of contact is different from what a lot of other companies do, where you call into a kind of one main number and wait to be assisted by the next available representative. Now, as far as our Learning Center, again, we pride ourselves on education. That's part of what today's presentation is of the webinars, the seminars that we do on a monthly and weekly basis to really educate you. We bring in a lot of guest speakers at times, hopefully bring a lot of value to each individual, not just on the self-directed side, but all of the areas that are ancillary to that. We've had attorneys, CPAs, multifamily syndicators on and to talk about what they do and share their investments. And all of our webinars, at least, are recorded and available on our on-demand channel. So please check that out on our website as well. Now we're talking a little bit now about the self-directed plans that we offer. I'm going to focus again more so on the solo 401k plan, which is the topic really of today's presentation. Now, any type of IRA, if you've listened to our presentation, you know any type of IRA can be self-directed. Traditional IRA or a Roth IRA for individuals. You have the SEP and the simple IRAs for small business owners. Those accounts can all be self-directed. The only difference there is our contribution limits and some of the tax treatment between the traditional and Roth IRA accounts. You can also self-direct any former employer's plan. So if you have an old 401k, an old 403b plan, those monies can be rolled over into an IRA and self-directed as well. Now again, the one account that we're going to really focus on today, though, is the solo K or solo 401k. People call it an individual K, an individual 401k, uni-K. All those terms really talking about the same type of an account. We typically here at Advanta call it, at least in the purpose of this presentation, a solo K or a solo 401k plan. But again, there are a lot of different types of employers' plans. I kind of want to cover a little bit of those so you have an understanding of what those are. Again, what we're talking about today is a solo 401k, and that's for specific, one individual or sole proprietorships to have. But there are, obviously, most people are familiar with a 401k because they work through an employer, a private employer, who puts money into their account each month, or they defer their salary, or a combination of both. Those are deferred contribution plans. Both the individual employee and the company define the contribution they're going to make to the plan. Going forward, the individual then has a variety of assets to choose from with which to invest those funds into. There are also 403b plans. And again, all these acronyms, 401k, 403b, as we get to it, 457, are the code sections of the IRS where these laws were essentially made. So that's where they get those terms. A 403b is essentially like a 401k, but for public education employees, teachers, people who work in the education system, have 403bs, again, where contributions may be made by the government or also then is the individual teacher, for instance, putting a portion of their salary into a 403b. There are 457s, which again are also deferred compensation, deferred contribution plans for other government employees. There's TSP plans or thrift savings plans for certain government employees. Typically, individuals in the military, also at the Postal Service, have TSP plans, again, that work a lot like 401ks as well. And then the other type of employer plan that you find out there are also pension plans. Now, these are not around as much as they used to be. And the reason being, pension plans are defined benefit plans. Now, 401ks, 403bs, 457s, etc., are all defined contribution, where it's agreed upon up front how much the employee will contribute, how much the employer will contribute, and then from there the growth of the account is really up to the account owner and what they choose to invest in. Pensions are defined benefit plans, or if you work for a company, they outline if you work for us for a certain period of time, or so forth, then we're going to give you a certain benefit at retirement. We're going to give you X number of dollars per month once you retire. So they're defining up front what the benefit of that is. Okay, so they're saying we're going to give you $500 a month after age 65, for example. That means that employer is on the hook to make sure that that $500 is there per month for you when it's time for you to take your pension, and obviously for all their other employers as well. So again, just the different types of employer-sponsored plans. Again, once you reach 59 or 59 and a half, I should say, or if you no longer work for the employer, you can roll those funds into a self-directed account. So just keep that in mind. If you have a 401k or 403b, you can roll those monies out at age 59 and a half, or if you no longer work for the employer. And sometimes each plan might have a little bit different rules, you may be able to, even if while you're still employed and under 59.5, do a partial rollover as well. Now the 401k accounts that we have here at Advanta IRA are the individual 401k, or again, solo K, and we have it in kind of two different options. One is basically, we'll take a step back. The solo 401k, again, essentially, as I've mentioned already, is a 401k plan, a defined contribution plan for individuals who either own their own business or who are sole proprietors and want to be able to make the larger contribution limits that typically 401k plans allow for. Now, with traditional regular IRA accounts, you're limited to, for instance, contributing $5,500 a year. Regardless of your salary, regardless of what you make, that is your maximum contribution limit for a traditional IRA. Solo 401ks, if you qualify, and really I should say any 401k if you have one through your employer, you can defer up to $18,000 a year of your salary, and then your employer can do a matching contribution on top of that. So you get a much larger contribution limit by using a 401k as opposed to just an IRA. So a solo 401k, again, is specifically for sole proprietors and self-employed individuals who own their own businesses and who don't have any employees who would also qualify underneath the 401k plan. Now, 401k plans in general, if you have a company with a number of employees and you have a 401k plan, that 401k plan must undergo certain testing on an annual basis to make sure that all individuals in the plan are being treated fairly underneath the provisions of that particular 401k plan. What's great about the solo plan is if you are the only owner and you're the only employee, there is no discrimination testing because there is no one to discriminate against. The plan is simply for the benefit of the business owner and also, in this case, the 401k plan owner. So these particular solo K plans are more streamlined. They're easier to do, and that's why we hold those at Advanta. We don't do the testing and compliance for larger 401k plans where it's not something that we do, but we can hold these solo 401k plans for people who own their own businesses. Now, we kind of, again, can do the solo 401k in one of two options. One, we call it kind of our full service model, and that is where we will provide the IRS approved plan. So when you have a 401k, you must have a 401k plan. We have an already approved IRS or 401k plan, been approved by the IRS, so we can provide you not only with that plan to lease from us, but we'll also do the record-keeping service associated with it. So we will take in contributions, we will make the investments on your behalf, we will keep track of all the income and expenses for those investments, like we do with our IRA accounts. So that's kind of our full service model. We do both the plan, we lease the plan to you, and we provide all the record-keeping services. Now there also is we call a do-your-own 401k. Same 401k plan, so it's still for sole proprietors, self-employed individuals, you don't have any employees. The difference with the do-your-own plan is that we only provide the 401k plan for you. So we can give you the plan document, you can lease it for us. You as the trustee of your plan can then go to a local bank, open up that solo 401k plan for yourself, and do your own record-keeping duties. You can buy your own assets in the 401k, keep track of the income, make the contributions, and do all of that record-keeping and reporting yourself. And so for some people that want to have a checkbook control over their account, they don't feel like they really need us to do the record-keeping. The do your own plan just allows you to have a much greater degree of control. We'll talk a little bit more about that in just a minute. Now, under both of these plans, one thing Advanta doesn't do is we do not do the 5500 filing. That is the annual return. If there is a 401k plan is required at certain points to file a tax form, return 5500 to the IRS. That is not something that we do, but we can certainly refer you to individuals who can help you with that particular return. Now we do offer one other plan I just wanted to mention. We have a plan, we call it a record-keeping plan here at Advanta. So if you already have a 401k plan document, so you've already established a 401k plan for yourself, so you have the plan, but you need someone to actually hold the assets, or if it's a cash balance plan or profit-sharing plans or even pension plans as well, you can open basically a sub-account within your 401k at Advanta where we can simply hold the alternative assets. So you may have your 401k plan, and you may have some of your assets held with a brokerage firm, but you want to move a portion of those funds within the plan into self-directed assets. We can open up a record-keeping plan and do that and hold those assets and then report, issue a report at the end of each year to you or to whoever your third-party administrator is who is doing the reporting for your 401k or your cash balance plan, and allow them to do the reporting. So we've seen a lot of record-keeping plans for doctors' offices, attorneys' offices, CPAs' offices, or even some smaller offices that need those alternative assets held within their plan. We can help them do that. So we're going to focus again more so though on the individual 401k full service model and also the do your own model going forward as well. So some similarities. Again, we've talked a lot about, we talk in our presentations a lot of times people hear self-directed IRA. Well, of course, we're talking about self-directed solo 401k. There are definitely a lot of similarities between these types of accounts, but there are also some differences. Similarities: to contribute to both either an IRA or a 401k, you're going to have earned income to make that contribution. The growth within the account, so your gains, your profits are all either tax deferred or possibly tax free depending on the type of IRA or 401k that you have. Both of them are subject to the restrictions under Code Section 4975. Those would be your disqualifying transactions. Again, for an IRA or 401k, you cannot invest in life insurance or collectibles, and you can also not have your IRA or 401k deal with certain disqualified persons, which include yourself, your spouse, certain other family members as well. So they're both subject to those same restrictions. Both of those investments, when you have income that is generated, so if your IRA or 401k owns a piece of real estate, the rental income must come back into that particular account, and any expenses must be paid out of that account as well. So those same rules apply on how to administer those assets. Both of them have the same rule that you can take distributions after age 59 and a half without paying any kind of early withdrawal penalty. And with both an IRA or 401k, you can partner those particular accounts with other people, other personal funds, etc., to make investments as well. So again, they have a lot of similarities on different things that you can and can't do, and kind of in how they operate as well. But there certainly are some differences, though, that you want to be aware of, and this sometimes can make a determination on how what type of account you set up if you're eligible for either an IRA or a solo 401k. Now you can see on this slide the IRAs are in blue and the solo 401k rules are in red. Now with an IRA account, you must have an approved IRS custodian. Again, that's the role that Advanta serves for our IRA accounts, because you cannot simply open up a bank account, title it as the Joe Smith IRA, and make contributions to it. You must, for an IRA, go through an approved IRS custodian. Now, if you are looking to do a solo 401k, I was just talking about the do your own plan, where you as the trustee of your plan can open up your own bank account, titled in the name of your 401k, make your contributions, and do your own record keeping as the trustee of that plan. So again, that gives you a lot more control, a lot more autonomy for having that particular 401k plan. Now with IRAs, you are not permitted to borrow from your IRA account. So your IRA cannot lend you money for whatever purpose that you may need it for. Now with a 401k, and some of you who are involved in 401ks might know this is already as well, and what's true of a solo 401k, you can borrow take a personal loan from your 401k up to either 50% of the total value of the account or $50,000, whichever is less. So you can borrow from and then pay back your particular 401k plan. With an IRA account, if you purchase real estate and you use a leverage or a mortgage to buy that property, your IRA is then subject to what's called unrelated business income tax or unrelated debt finance income tax on the income that your IRA then receives from that investment. Very quickly, let's say your IRA puts 30% down, your IRA borrows the other 70% of the purchase price. then your IRA is now going to be subject to this UDFI tax on 70% of the income that it receives. So it's not against the rules, it just means you're going to have to factor that tax into your overall return. 401k plans, in this case again solo 401ks, do not pay this tax on acquisition debt. So if you're buying a property where your solo K puts down 30% and your solo 401k then borrows 70%, that income coming back into the plan is not going to be subject to that UDFI tax. Now, if you do buy a property from somebody with an existing mortgage attached, you may have tax implications there. That's why it says it doesn't pay tax on the acquisition debt. Another difference, with an IRA, if you're opening up a Roth IRA, your ability to contribute to that Roth is often limited by your modified adjusted gross income. If you, in a sense, your income, your adjusted gross income is too high and over the threshold, you simply cannot contribute to a Roth IRA account. Now, solo 401ks, again, you can defer a portion of your salary each year up to $18,000 into a solo 401k. You have the ability, if you wish, to make that salary contribution as a Roth contribution to your 401k, and that contribution for the Roth 401k is not limited or affected by your adjusted gross income. Another difference, again, we're talking about IRAs. If you want checkbook control, being able to do your own record keeping, where you can write the checks out of the account to pay bills, you can receive the income, you can make investments, you need to use an LLC or a trust or some other type of entity to get that degree of control. As we talked about already, the solo 401k, you can set up a checking account at a local bank in the name of the 401k under the do your own option, do all of your record keeping yourself. Last difference we'll cover, there's a couple others that are smaller, but the other big one to consider, with an IRA account, if you engage in a prohibited transaction, so you buy life insurance, you buy a collectible, you lend money to somebody who was disqualified, that transaction is a prohibited transaction, your IRA loses its tax-exempt status. So if I had $100,000 in my IRA and I make a prohibited transaction, that $100,000 ceases to be tax protected. I will now owe income tax on that money as well as possible penalties depending on how long that prohibited transaction has been taking place. With a 401k, that same transaction, it begins with a 15% penalty. Now with an IRA, it begins with your IRA is disqualified, no longer tax exempt. The 401k penalties are not quite as severe. So again, these are just some of the differences, some to highlight for 401ks and IRAs. There might be a few others as well. I'd be happy to, again, take questions on those if somebody has a question on the differences between these accounts. Now moving money to a self-directed account, you can go a couple different ways especially into a solo 401k. One is you could transfer money. If you have money in an existing IRA or in some other solo 401k, you can do a transfer whereby Advanta will send you'll fill out a document. We send that transfer form to your other custodian, requesting them to send the money to your 401k account with us. That's a transfer. It's non-recordable. It's non-taxable because the money never touches your hands. And you can do transfers between accounts as often and whenever you would like. The other way you can move funds is via direct rollover, and this typically happens with employer-sponsored plans. If you have a 401k or a 403b or a 457 plan, and you want to move that money from that account either to an IRA or to your solo 401k, the term is just a direct rollover. And you would initiate this as the account owner. You would initiate that with a third-party administrator with your old employer's plan, directing them to roll the funds over into your IRA or solo 401k. Now these events are recordable. There is some tax reporting that happens, but there's still no tax consequences. As long as the money goes directly from the old plan into the new one, money doesn't touch your hand. It's a non-taxable event. A good question just came up, and a good one. Again, I encourage anyone else to ask them as they have them. So this is, are there any fees or costs to transfer or do a direct rollover? I can tell you, certainly no IRS fees. There's no taxes, no penalties, etc. As far as fees, money coming into Advanta, we do not charge any transfer or rollover fee in bringing those monies in unless money is wired to us. We have a small wire fee. But as far as transferring and doing direct rollovers, you would need to talk to the administrator of the company basically that's holding your current plan to see if they have any fees or costs associated on their end. But we do not charge anything on our end when we have monies coming into us by transfer or direct rollover, like I said, unless that money is wired. But great question, and again, if anyone has any other questions as we go, please type those into the chat box on the screen. All right, so investment options. With solo 401ks, IRAs, a lot of the similar types of things, especially when we talk about real estate. Do an IRA, or you could do in a solo K, whether it's you're buying rental properties, commercial, residential rentals, you're rehabbing or flipping a property, buying raw land, private real estate trusts, condos, duplexes, mortgage notes, assignments. Again, the list really is pretty lengthy when it comes to investing into different types of real estate assets. And again, you have those same options, whether it's an IRA or whether it's a 401k account. Again, the IRS says there's only a few things that you can't do within your solo 401k or your IRA. You can't buy collectibles or life insurance. Again, collectibles would include antiques, alcohol, artwork, stamps, coins. There are a few coins if they are gold or silver, minted U.S. coins or some other types that can be purchased within that solo 401k. But those are the two investments you can't make. And the other thing I mentioned, you can't have your plan, in this case your 401k plan or your IRA, cannot deal with certain disqualified persons. And the disqualified persons for your IRA or solo K account are the account owner and their spouse, so you and your spouse, your parents and grandparents, your lineal ascendants, your kids and grandkids, your lineal descendants, and any businesses or entities that are owned or controlled by some of those individuals as well. These are all disqualified individuals who cannot transact with your IRA or your 401k. Again, the one restriction is if you have a 401k plan, you may be able to take a personal loan as an individual, but that's really the only exemption there. Now, before I get into the case study, we have a couple other great questions pop up when we get to those here. Person says, if a person already has a self-directed IRA, can the self-directed IRA be converted to a business solo 401k? And the answer is yes. If you own your own business, and you're a sole proprietor, you qualify, your business can start its own solo 401k, then you can certainly roll over or transfer a traditional IRA or a SEP IRA into your new solo 401k. So you do have, the answer to that question is yes, although there is one particular exception to that yes. If you have a self-directed Roth IRA, or for that matter any type of Roth IRA, you cannot roll or transfer a Roth IRA into a solo 401k plan. It's just simply not all around. Rules came out a long time ago. I was told by a consultant that we talked with that the simple reason was that Congress, whoever was writing the rule, messed up, and it was something that's never been corrected. So Roth IRAs cannot be put into a solo K, but any other type of IRA, whether it's self-directed or not, can be transferred or roll over into that solo 401k. Question says, if I make an investment with a partner, how do I put my portion into my Roth account? The answer to that question is if you have a Roth account, or in this case, or maybe a Roth 401k, you would just make sure that the investment documents are titled so that your interest is titled in the name of your Roth IRA. So, for instance, let's say I have a friend of mine, Joe. Joe and I are going to do a deal where my Roth IRA account is going to be putting in the cash for my portion of that property. If we're buying, for instance, a piece of real estate, the titling on the contract, on the deed, would be Joe as to a, say, 50% interest, and Advanta IRA for benefit of Scott Mauer's Roth IRA as to a 50% interest. So what we do at Advanta is to make sure that if you're partnering and having your IRA buy an interest alongside other individuals, or maybe just one other individual, that your IRA, or in this case your Roth IRA, is properly titled as the partner in that deal. So that in a sense puts that portion of your investment into a Roth IRA by making sure it's titled correctly and then having the funds leave your account at Advanta to actually purchase that particular investment. Another question is, if I have a W-2 job and I have an LLC for real estate, wife and I are owners, no employees, can we do a solo 401k under the LLC? The answer is yes. Solo 401ks, although we would say solo, you think of one, the solo 401k can be used for any business where there are no, it can be used, say, for instance, if I own my own business, my spouse can be included, and any other owners of the business can all be included in a solo 401k. But since you don't have any employees, you would qualify to do a solo 401k underneath the LLC. Now, a couple other things in your question. If you have a W-2 job and you are already contributing to that W-2 job as in a 401k with that company, your contributions to that company will limit how much you can then contribute to your solo 401k. So it's just something you can't kind of make double contributions, but you could, if you have an LLC for real estate, have a solo 401k set up for that particular entity. Now, the one other caveat to that is if you have an LLC for real estate, if that LLC is receiving, all it's receiving is passive income, for instance, you're not taking a salary or paying self-employment taxes, you may not qualify to really contribute underneath that solo 401k. So you still have to have earned income to contribute to and have a solo 401k, and earned income is typically you're paying yourself a salary from your business, or you're paying Social Security, other self-employment taxes on that as well. But as far as having a W-2 job does not preclude you from opening up a solo 401k. It just may limit ultimately how much in contributions you're able to make. Let's see, we had another question came up. Let's see, you mentioned qualified funds could be directed to another account. My spouse is a part owner of a business with Merrill Lynch as the administrator. Can a portion of the qualified funds be transferred into an Advanta account? The answer to your question is yes, is that you could, if you're a part owner of a business and Merrill Lynch is the administrator for that 401k, if your spouse is the part owner, they would have the ability to make changes to their 401k plan to allow for self-directed assets. However, I don't know if we've had a direct experience with Merrill Lynch. The issue that you might have is Merrill Lynch is acting truly as the third-party administrator. They may say that, hey, we're acting as the administrator. You cannot move the assets to anywhere else if you want to have us continue to act as the administrator. We're not going to allow for it. However, your spouse is a part owner of a business, could certainly elect to choose a different administrator. We can give you certainly names of third-party administrators to do that. It might be a little bit more work involved, but you could do that. You could change the administrator of the plan, find someone who will allow for self-directed, allow for Advanta accounts, and then in turn do that. So it is possible. I would encourage you to call our office to kind of talk through that in a little bit more detail. But that is when I mentioned the record-keeping account earlier. If Merrill Lynch would allow for it, your spouse can keep part of their 401k at Merrill Lynch, move a portion of that to a record-keeping account with Advanta that's still underneath that whole 401k. Does a direct rollover count towards the contribution limits for the solo 401k? Good question. No, it does not. Any transfers or rollovers from other accounts into an IRA or into a 401k never count against your ability to make an annual contribution to either a solo K or even to IRAs as well. So those do not count towards your limits, nor does the income that is generated from an investment count against your contribution limits. Some other question said, Roth 401k, didn't know this existed. Can I explain the contribution limits versus the regular 401k? So I'll hit this quickly, and then we'll move on to some case studies. With a 401k, whether it's a solo K or whether it's an employer-sponsored plan, you always have two types of contributions. You have the employee, who can defer a portion of their salary into the plan each year. And that limit is as an employee, you can defer up to $18,000 a year If you're over 50, you can defer up to $24,000 of salary a year. And that salary deferral can be made as either a regular tax-deferred contribution, which would lower your tax bill this year because you get a deduction for it, or you can make that salary deferral at $18,000 or $24,000 as a Roth contribution. Now, you do have to have a plan that allows for Roth contributions. Our 401k plan certainly does, and I'm sure a lot of them out there do. The other type of contribution, other than employee, is the employer contribution. And the employer is the one that does the matching contribution into the particular plan. The employer's contribution can be anywhere from no matching up to, an employer can say they will match up to 25% of your overall compensation into the 401k plan as well. That money is always tax deferred. That is not a Roth contribution. But specifically asking about a Roth 401k, it is that salary deferral that you as the employer making that can be designated, again, up to $18,000 or $24,000 as a Roth 401k. All right, I hope I answered those questions. I'll move on to the case studies now, make sure we get enough time to get through all these. If you have other questions, please fire them back in. Get them into the chat box. We'll get those answered. Just quickly getting started. It doesn't take very long to open up an account. We can have an account open typically within 15 minutes or a half hour to go through the paperwork and get the account open that day. You can fund your 401k by making your contribution, making a transfer or rollover from another account, and then ultimately you have those funds, you're ready to start investing and placing your 401k money, or again maybe your IRA, into a particular investment. So we help you. The 401k plan is a little bit more involved than setting up an IRA, but we help you through that process. We help you get a tax ID number for your 401k plan, make sure it gets titled correctly, etc. So it does take a little bit longer than an IRA, but all of this still easily done in a very short period of time. All right, so our first case study, we're again talking about buying real estate today within a solo 401k. And we're going to go through this first one. This first example is really kind of the same example, just a different scenario, but using the full service model. So again, the full service model, not only is Advanta providing the plan, we're also doing the record keeping as well. So John has set up a 401k plan for his business, JES Plumbing LLC. He's got about $150,000 in there and wants to buy a piece of real estate. So John's 401k plan, which he has titled the JES 401k plan, that plan can invest because it's self-directed, invest in a lot of different types of assets. He moves $150,000 over to Advanta so he has control. And of course, John again realizes that all the income from those investments will come back into the 401k. Expenses will get paid out. Now, since Advanta is doing the record keeping, we will receive and deposit the income back into his account and pay any bills at his direction. So all of the cash, John will not have any control over that cash other than to direct us when to pay a bill, or maybe in this case direct his tenants to send a rent check back into his 401k plan. Now actually buying the real estate, again using our full service model, in this case using a solo 401k, the property must be purchased in the name of his solo 401k. And you can see there in red what that wording would be. It's John Smith as trustee for the JES 401k plan, account number 1234. In this case, that account number is the account number that corresponds with his Advanta account. So we know exactly which client this is for. But the account is titled in his name as trustee of that particular plan. All of the funds would come from the solo 401k plan. So again, Advanta is going to send the cash out of his plan to make the purchase. All of the income comes back in, again, tax-free. And we will record keep all the money coming in and going out of the account. So we will work with John all the way from the contract of putting this property under contract in the name of his 401k up through closing, making sure that that titling in red on this slide appears on all the closing documents, make sure John has approved of the documents, and ultimately, in this instance, John will sign the closing documents as trustee of the 401k plan. Those of you who've had self-directed IRAs know that typically Advanta will sign as the custodian and record keeper on behalf of your IRA. But when you're doing a solo 401k, you are the trustee of the plan. You will actually be the one executing the documents on behalf of the plan itself. So a little bit different than with an IRA. Now, so John buys the property. His offer is accepted at $140,000. So ultimately, his deal is funded and purchased within his plan. His investment strategy was just simply to hold this property for rent for a number of years. So his 401k is going to receive that net rent each month. Let's assume John gets $1,000 a month net from that property over 4 years. That's $48,000 back into this particular 401k plan. And if he sells the property in year 5 and he sells it for a profit, that profit also coming back into his 401k plan. So he started out with $140,000, and in 5 years, he was able to make through the rents and the appreciation of the real estate an extra $98,000 back into his account. So 5 years later, John went from $140,000 to $238,000 in his solo K just by doing this particular deal. And that's, I think, one of the powers, not whether it's an IRA or 401k, that real estate has is the ability to not only earn income on a monthly basis, but also having that long-term appreciation as well. Now let's take this kind of same example, but let's structure it. Let's look at it from the do-your-own model, because again, we're seeing a lot more people interested in this do-your-own model where they're in control of the checkbook and the reporting. So again, John has his 401k. He sets up the JES 401k plan. Under the do-it-yourself or do-your-own model, John is going to lease our plan document. So we will give him a copy of our 401k plan document, and we will help him obtain an employer identification number or a tax ID number through the IRS for his 401k. And John will be able to take his plan documents and the tax ID number, and we also provide a letter of instruction to go along with that, to a local bank to get an account open in the name of the JES 401k plan. So John, as trustee of the plan, is establishing this bank account in the name of his 401k plan. He can move the funds from his other IRAs or 401k into that plan. And going forward, John will be able to write checks out of that bank account, again, titled in the name of JES 401k, be able to provide, write checks out, receive income, and do all of his activity in and out of that bank account. All we are going to do at Advanta is provide him with that 401k plan. You lease our document. The fee is roughly $300 a year to lease the plan. No other charge other than that. If John were to go to an attorney or someone else or a CPA maybe to have him draft his own 401k, those typically start at a couple $1,000s to get a 401k plan. We will lease it to you for $300 a year. John, again, as trustee, is going to be responsible for any IRS reporting of contributions, distributions, and again, filing that annual 5500 return as well if that's needed. Now, 5500 returns for solo 401ks generally are not required until the assets of the 401k exceed $250,000 in value, or if the plan is terminated. So even if you started a plan and you never got more than $100,000 or so before you terminated it, you do have to file a final return, 5500. Again, John as trustee is always going to be responsible for that, whether it's a do-your-own model or the full-service model as well. So how does this look like in the purchase process? Again, the property is still bought in the name of the 401k. John Smith as trustee for that plan. It's just going forward, all the income is going and the expenses are going in and out of that particular bank account. Okay, John again is trustee, still signing the closing documents, still entering into the contract, etc. It's just he now has the ability to control that cash and do all that reporting. So it does give him, like let's say in the industry, typically we refer to a lot of times as checkbook control. Good question came up. What if after John transfers the money to the solo K, he can't work and no more earned income? Can the plan still exist without earned income? I think the answer to how you phrase that question, the answer is yes. You can continue to have the 401k plan in existence without contributions. The IRS does not require you with an IRA or with a 401k to contribute every single year. You can go time in between if you don't have the ability to make the contribution. You simply don't make it. What the IRS, though, does frown upon are individuals opening up, say, a solo 401k plan and never making any contributions whatsoever. Okay, so if you open up a 401k plan and never have the earned income, never really had the intent to have a 401k plan, all you were really looking at doing was taking advantages of some of the differences between a 401k and an IRA, you can have some issues there because the IRS may look at that as not really a bona fide 401k plan. But if you were to establish a plan, maybe you make a small initial contribution, it turns out you never make any more after that because of other circumstances, that's not going to be a disqualifying event. So in your answer, in your question, it may sound like he pulled out he can't work after he does this. That's one thing. If he knows going in he's never going to have earned income, never really going to have this other business, you can't just set up a solo 401k for that reason. All right, and we talk about, again, the do-your-own model. It gives you what they call, again, checkbook control. Now, in the industry, we talk a lot about checkbook control as it relates to IRAs. And again, because of an IRA, I mentioned a little while back, one of the differences with an IRA and 401k is to get checkbook control with an IRA, you have to have an LLC or a trust, some other entity to get that control. Otherwise, your IRA custodian, again, in this case, Advanta, would be the one issuing the checks. But checkbook control for a 401k is utilized or is achieved by using the do-your-own model, where you can effectively gain the checkbook control with the 401k fund just by opening up that bank account in the name of the 401k plan itself. If he wants, in this case, if John wants that similar control and wants us to do the record keeping, he would still need to do a separate LLC that is owned by the 401k plan. John's the manager. The 401k account itself is the owner of the membership of the LLC. As for why someone might do the second option, some people just like to have that extra barrier between themselves and the 401k, in this case the LLC. Sometimes LLCs can also potentially give you more liability protection or whatnot. But for the most part, a lot of people looking for checkbook control within their solo 401k, the do-your-own model works very well because it allows you to have that on your own bank account, write the checks, receive the income. Although I would say if you're going to do the do-your-own model, you certainly want to have your CPA, your tax advisor, your enrolled agent, whoever you're using, on board with what you're doing so that they can help guide you. They can make sure all your reporting gets done correctly, making sure you're keeping track of your books correctly, because, again, that's going to be something that you're now responsible for. If we're doing the full service model, we are keeping track of those records. At least you have a record of your contributions into the account. You have a record of all the income and expenses that are paid out of the account going forward. So, again, some people like that little bit separation between themselves. But if you have a good idea what you're looking to do and you have a CPA or a tax advisor on board, the do-your-own model can certainly be beneficial as well. So again, what are the pros and cons of the full service or the do-your-own model? Again, with the full service model, Advanta is receiving the income, paying the expenses out of the account. So you have that kind of, again, arm's length from the actual funds in your accounts. As I mentioned a minute ago, you have that clear record of the funds in, funds out of that particular account. Because you have that arm's length between yourself and the plan, you probably then are less likely to do something that's prohibited, because to make an investment, you're going to have Advanta or ask Advanta to facilitate that investment. And if we see something that looks like it might be disqualified or prohibited, we're going to bring that to your attention. With the full service model, you're going to submit forms to us, or requests for either checks or to make an investment in the account. And then ultimately the 401k owner, and the trustee, if it's your plan, you're the trustee, you're going to be filing those necessary IRS forms to report contributions, distributions, and also doing the annual report as well. Now, the do-your-own model, as we've talked about, you have greater freedom and control, but you reduce fees. And somebody did ask a question, what is the fee structure? Since Advanta is not doing any record keeping, under the do-your-own model, the only fee you are charged is a $300 a year fee to lease our plan document. Under the full service model, you are charged a $300 a year fee for the plan document, and we charge our normal transaction fees, where we charge $95 per transaction to go through a process of purchase from start to finish. It's a $95 for anything other than real estate, $145 for real estate itself. And then we have our annual fee, our annual record-keeping fee for that asset of a flat $295 a year. So full service model, it's a $300 a year to lease the plan and $295 a year to record keep the asset as well. To do your own model, again, you simply have that $300 a year fee. So we have a couple of questions pop up here I want to make sure I get to before we end the webinar today. Let me go back up and read this question. So if I do not own or manage a business, but I am a non-managing principal in a private equity firm, I'm selective in my investments and projects that my firm is involved with. I have a personal IRA, not a 401k, that is managed by a private wealth manager. Associated with UBS, I'd like to diversify a portion of those IRA funds into alternative investments that my firm invests or purchases as a GP or LP, like oil and gas and other private. Different people are telling me to be careful about self-dealing. Well, who determines whether an investment is self-dealing? It's a lot of facts there, but it ultimately gets to a good question. In determining whether something is self-dealing, sometimes issues are cut and dry. For instance, in this case, you're asking about an IRA. If your IRA wants to make an investment and buy a piece of real estate that you already own, that's clearly not allowed. You're not allowed to transact with yourself in that manner. But the other situations certainly get more gray and get into a different area where, in this case, it talks about your IRA wants to invest in a private partnership that the company that you work for, and you're in a non-managerial role, but your firm is going to invest or be in charge of managing that particular investment. That gets a little bit tricky because now you're involved in that company. A lot of times the question, it comes down to whether or not you personally as an individual are benefiting from that transaction. So going back to the prohibited transaction rules, you are a disqualified person for your IRA account, and no disqualified person should either transact with the IRA, which it doesn't sound like that's happening in this instance because it's your company that you don't really have any managerial role in. You just have you're in a sense kind of an employee or principal. But the other issue can be whether or not you as a disqualified person are getting any other type of personal benefit. For instance, your IRA is going to make this investment into this new private partnership that your company is managing or is a part of. If you personally are then going to get any kind of additional bonus or special treatment, other favoritism, things like that, that's where the IRS could look at that as you getting some other type of current personal benefit. Again, there's a lot of facts there. There's a lot of moving parts. Ultimately, who determines whether an investment is self-dealing, that's something typically to talk to an attorney about, usually someone who is familiar with ERISA law, that's ERISA law that covers 401ks and covers IRA accounts, to try to get a final determination. But I would certainly be happy to talk to you offline and get some more facts involved there as well. I hope you can at least arrive at least a different answer or know who to talk to. Based on what we learned, actually the follow-up to that question, so there's no personal benefit other than maybe, I guess, the investment itself, the return that comes in, then that certainly might be something that you would be able to do. Again, I probably will just talk to you offline to get more facts and find out a little bit more details. Based on what we've learned so far, it seems that the solo K is better than the self-directed IRA in various items. What reason would you recommend using the self-directed IRA? That's a good question. Reason why people use the self-directed IRA is, again, not everybody qualifies, number one, to even have a solo 401k. Okay, I personally do not own my own business. Scott, the individual doing the webinar today, I cannot have a solo 401k because I don't have a business that sponsors it. So if I ever wanted to self-direct, I have to do that through an IRA. Also, if you're really not in need of those larger contribution limits, okay, again, 401ks, you can contribute a lot more per year than an IRA. If you're not in need of those contribution limits, then you really don't need to incur an extra $300 a year to have the 401k plan, as well as the other costs of preparing or having a CPA prepare your annual 5,500 filings, your contributions, etc. So in that sense, if you're not looking for those contributions, it doesn't necessarily make sense there. So again, solo K can definitely be better for people who own their own business, looking to make some contributions. It makes more sense. If you're not looking at all for those reasons, the self-directed IRA works just fine. All right, well, at this point, I want to conclude today's webinar. I want to thank everybody that logged in and called in live for our webinar on the solo 401k and investing in real estate. Again, here's my information for those of you who had some good questions during the webinar. If you want to reach out to me or have additional questions, here's my contact information. I'll be happy to walk through some of those issues with you. But this time, thank you again very much for logging in, and we hope to hear you and have you here on our next webinar.